I know that your handlings with the FDIC are private. However, you are the perfect person to talk to about whether you think that this crisis is over.
Well, put me on the spot. Look, First Republic and Silicon Valley Bank were on the far end of the distribution in terms of the percentage of their deposits that were uninsured and the percentage of their assets that were long-dated, low-yielding securities. So they were ripe for the stress that came upon them. The stress in the banking market, in the regional banking market today, I think is really a function of the stock market. The last thing a bank wants is to be in the news. You're right, you just want to go about your business and not attract attention, take deposits, make loans. And what's going on in the stock market with the regional banks, I think, is completely unfair. The deposit attrition has slowed to really a trickle among these banks, and they were far less exposed to long duration low-yielding assets. So I think this is really more a function of the stock market talking to itself, short sellers doing their thing, than it is actually a reflection of the reality.
But do you have a fear here that they will, or the short sellers or the market itself will talk the sector into more trouble? And at what point does the SEC need to intervene with some sort of short selling rule?
Look, there is an adverse feedback loop between adverse headlines. The stock declined 30% today. A depositor picks that up, it gets nervous, and should do. And so I do think there is a role for the SEC here. I don't know if we go all the way back to 2010, where there actually was, or 2008, where there was a short sale ban on financial institution stocks. But surely the SEC can act on the Dodd-Frank mandate to provide more transparency as to what the short interest is in these stocks on a periodic basis, so that you all can do your job and call these short sellers out.
I am curious to get your thoughts on kind of the second order effects of all this. There's been a lot of concern here. I mean, you mentioned deposit flows. We know that for most of these banks, it's been relatively stable. The outflows have basically stabilized, not necessarily sort of that worst case scenario everybody was pricing in. There is a concern about lending going forward, not just the capacity to lend, but really the willingness of these banks to lend here. Are you expecting to see a big pullback?
Listen, when you're trying to protect your liquidity, you're not using that liquidity for lending. And so I think there will be, and I think the Fed said in the financial stability report they released yesterday, and the senior loan officer survey suggested that there is a slowdown in lending activity.
What fills that hole, if anything? If the banks are pulling back, last week, both Sonali and I were out at Milken. There was a lot of folks, obviously, as you know, from the world of private equity and private credit, and a lot of them were talking about the opportunities in direct lending.
Yes, listen, the growth of the private credit markets has been extraordinary, and those people are, raised money and they have to put it to work. So I think there is, real availability there, but one of these things is bigger than the other.
Well, that's my question, because how much of a hole can they fill? Right. I mean, there's only so much they can do.
Exactly, and so, you've got a banking system with near $30 trillion of assets in it, and you've got a private credit sector that might have $1.5 trillion.
But, and they have left some of the market completely alone. In a minute here, Jim, how much do you expect restructuring activity, frankly, to pick up? Bankruptcies are already at the highest level since 2009.
Yeah, look, you can't go through this kind of rapid increase in interest rates and change in the funding costs for businesses and banks and insurance companies alike without seeing some real stresses. And so, companies that have maturities this year, next year, are going to face much higher refinancing costs. 500 basis points in increase in the base rate over the last year has ramifications throughout the credit markets.